For more than a century, the Dow Jones Industrial Average has been one of the most recognized symbols of the U.S. stock market. In many ways, the index itself has come to represent the economic strength and industrial power of the country. It has lived through wars, depressions, market crashes, and economic booms, and for generations, it has served as a benchmark for American equities. But markets evolve. And in 2026, the question isn't whether the Dow has a great history. It's whether the way it's constructed still makes sense in today's market. This is Dollar X Dollar, a channel dedicated to deep data-backed ETF research for long-term investors focused on building financial independence. In this video, I'll break down the DIA ETF, explain how the Dow's price-weighted structure works, compare its long-term performance with modern market cap-weighted indices, and assess who, if anyone, should still own it today. This isn't about hype or short-term performance. It's about index design, methodology, and whether tradition still holds up in a modern ETF-driven market. A quick disclaimer, this video is for educational purposes only and does not constitute financial advice. Without further ado, let's get started. Before we talk about index construction, let's briefly look at the ETF itself. DIA is the SPDR Dow Jones Industrial Average ETF Trust. It tracks the Dow Jones Industrial Average and holds the same 30 companies in the same proportions as the index. As of the end of 2025, DIA has around $44 billion in assets under management, making it one of the largest and most widely held U.S. equity ETFs. The fund is priced in U.S. dollars and charges an expense ratio of 0.16%, which is higher than broad market ETFs like SPY, but still relatively low by historical standards. DIA has also received a strong Morningstar rating, reflecting its long operating history and consistent exposure to large U.S. companies. So the question with DIA isn't fund quality or liquidity, it's whether the index it tracks is still the right tool for today's market. To understand why the Dow is controversial today, we need to look at how it's weighted. The Dow Jones Industrial Average is a price-weighted index. That means companies with higher share prices have more influence on the index, regardless of how large or important the business actually is. For example, a $400 stock will move the Dow more than a $200 stock, even if the $200 company is twice the size. This isn't theoretical. You can see it directly in the DIA ETF's holdings. Goldman Sachs currently carries the highest weight in DIA, not because it's the largest company in the index, but because it has one of the highest share prices among Dow constituents. Every company in the Dow is held in the same number of shares, so the stock with the highest price automatically has the most influence. Another clear example is Nvidia. Despite being one of the largest companies in the world, Nvidia makes up only about 2.4% of DIA, while it represents roughly 7.8% of SPY, which tracks the S&P 500. The difference has nothing to do with Nvidia's business performance. It comes purely from the index methodology. By contrast, market cap-weighted ETFs like SPY weight companies by their total market value, which better reflects where investor capital sits today. In a price-weighted index, even a stock split can materially change a company's influence, even though nothing about the underlying business has changed. To put everything into context, let's look at long-term results using a daily dollar cost averaging strategy. This backtest starts at the market bottom in March 2009 and runs through the end of December 2025, using the same daily $10 contributions for both portfolios. Over this period, a daily DCA into SPY grew to about $163,000, while the same strategy in DIA ended at roughly $134,000. That translates into a compound annual growth rate of around 14.5% for SPY, compared with about only 12.5% for DIA. The difference shows up clearly in risk-adjusted returns. Over the same period, SPY delivered a Sharpe ratio of about 0.90 and a Sortino ratio of roughly 1.28, while DIA posted a Sharpe ratio around 0.84 and a Sortino ratio near 1.20. In other words, SPY didn't just return more, it delivered more return per unit of risk and more upside relative to downside volatility. This is where index design matters. In a market cap-weighted index, companies that grow faster naturally become a larger part of the portfolio, allowing long-term winners to compound and drive returns. In a price-weighted index like the Dow, that effect is muted. Even when companies become significantly more valuable, their influence is capped by share price mechanics rather than economic size. Over a full market cycle, that structural difference compounds, and that's why a market cap-weighted index consistently delivers higher absolute and risk-adjusted returns over time. Before asking whether price weighting still makes sense, there are two common misconceptions about DIA worth clearing up. First, DIA is often described as a value or old economy index, But when you look at the actual sector allocation, that label doesn't fully hold. Around 20% of the fund is still exposed to information technology, alongside meaningful positions in companies like Microsoft and Nvidia. So DIA isn't a pure value index. It's a mix of financials, industrials, healthcare, and modern tech, just weighted in a very different way. If investors are looking for a clearer value tilt, ETFs like VTV and MGV provide a more traditional alternative. Both still include some technology exposure, but it's below 10%, which is meaningfully lower than what you see in DIA. The second misconception is income. Yes, DIA pays dividends monthly, which many investors like from a cash flow perspective, but the yield itself is relatively modest. Over recent years, DIA's dividend yield has generally hovered around 1% to 2%, which is not materially higher than broad market ETFs. In other words, DIA isn't a high-income ETF. The monthly payments are more about distribution timing than total income. Once you strip away the labels, the real issue isn't whether DIA is value-oriented or income-focused. It's whether its price-weighted structure still makes sense in today's market. So the real question is, does price weighting still make sense in today's market? Historically, it did. When the Dow was created, prices were calculated by hand, data was limited, and price weighting was a simple and practical solution. But today's market is very different. Markets now regularly experience stock splits, reverse splits, mergers, and corporate restructurings, and modern systems handle these events effortlessly. With today's computing power, index providers can adjust weights instantly and precisely, without relying on share price as a shortcut. That's why modern indices use market cap weighting. Market cap weighting allocates more capital to companies that are larger, more valuable, and growing faster, and naturally reduces exposure when those companies shrink. Price weighting doesn't do this. A company's influence is driven by its share price, not by its economic size, revenues, or role in the economy. Corporate actions like stock splits can materially change index weights, even though nothing about the underlying business has changed. In a modern ETF-driven market, that creates distortions rather than insight. Price weighting isn't broken, but it's no longer aligned with how investors allocate capital today. So who, if anyone, should still own DIA in 2026? DIA isn't broken. It has delivered strong long-term returns, it holds high-quality U.S. companies, and it remains one of the most recognizable benchmarks in the world. But as a core long-term equity holding, DIA is difficult to justify today. A price-weighted index introduces unnecessary distortions, limits the impact of long-term winners, and consistently lags modern, market cap-weighted indices on both absolute and risk-adjusted returns. That makes DIA a poor choice for investors building a passive long-term portfolio. That said, DIA can still make sense for a narrow group of investors. It may appeal to those who specifically want exposure to the Dow Jones Industrial Average, prefer a legacy benchmark, or value the monthly dividend payments, even though the yield is relatively low, at around 1% annually. For most investors, however, market cap-weighted ETFs provide a more accurate, efficient, and future-proof way to capture U.S. equity growth. In 2026, DIA isn't obsolete because it failed. It's obsolete because the market has moved on. If you found this breakdown useful, consider giving the video a like. It really helps the channel. And if you're interested in data-driven ETF analysis and long-term investing without the hype, feel free to subscribe. I post regular deep dives like this, focused on structure, methodology, and real-world results. Thanks for your time today. I will see you in the next one.